Hey everyone, welcome back to my Rosehart show. We're live again this week from the cottage. We're gonna try to do a not as long stream today, just because we were getting such a monsoon rain out there. I don't know if you guys can see that, but like just an insane amount of rain, and the power's been cutting in and out. So I may or may not lose internet here. So, oh, there we go. Just gonna sit on this table. Look at this table. It's kind of cool. It's made of a tree, chunk of tree. Okay. By the way, one of the things I want to talk about today is the amount of enough. When do you have enough? How do you know when you're there? And when you reach there, how do you know when to stop? And I'm at a point where like, whenever you do something you don't love, and there's pieces to every business that you don't love, and you do it for a long period of time and you push yourself, and then you don't see the results. I'll give an example. Trading. So I spend 1 to 2 hours a day reading articles about the stock market, the economic environment, stock reports, whatever. Like I'm just something involved with finance, and I enjoy that to an extent. But when you do that and you spend 1 to 2 hours every single day, and that's like, we'll call it 700 hours, probably a year that my mind is thinking about that, and I go and get shit on. Like I've just absolutely destroyed my portfolio this year. My year to date is insanely negative, and it's depressing. It's hard to want to do something when you don't get a result. It's demotivating. The same as in real estate right now. I know a lot of people, myself included, I just did a project, we're just finishing up, and we may make like 20 grand. I think it's like 15, 20 grand. And I was like, man, I spent like probably 100 hours on like locking up the deal, financing it, like managing the contractors, managing all the stuff you have to do to run that property like a business. And I'm like, man, the dollars per hour are like not that great. And it makes it hard for me to want to push. And it makes it hard for anyone really to be motivated, I think. And so that's what I've been struggling with today on this rainy, gloomy day here at the cottage. I was doing some fixes. I'm having a rough day today. We had our battery go in our car. We had a light go in our car. We had a bunch of damages in the Airbnb and stuff, and I had to deal with all that. It's like constant problems, which is like fine, because if you're making money, you got to deal with problems. That's part of running businesses. Anyone who says that their business is passive is lying, because there's management there. Whenever you have employees or people involved, there's problems. And when you're not making profit or enough profit, it makes it hard. It makes it hard not to just want to take my entire net worth and just lend it and just go chill. Like put some in this S&P 500, not think about it, put some into private lending and just do like completely passive, completely chill. So it's tough sometimes. I'm battling with that. And I feel like on a day like today, and maybe it's just because of the mood that I'm in, but I feel like retiring again. And I mean that in the truest sense, like just taking a sabbatical. And like Michael Jordan retiring, I'll come back and do a three-peat win. You know what I mean? Like I feel like I need a break. And there's not a better time than now to take a little sabbatical, because the bottom of the market is coming, and I think there's gonna be a great opportunity, and I wanna jump on that. And I don't wanna miss out. The greed in me can't miss out on like growing my net worth more, but philosophically speaking, like when is enough? Like I literally can't spend the only way I can deplete what I have is by taking massive risk. So if I don't take massive risk, I can never be poor. Like I can't spend my way out of my current net worth, my current passive income. All I have to do is just not be stupid. Just not invest it stupidly. Be careful with it, be frugal with it, and I can't lose. And so that's a mindset thing that I've been kind of battling with. Hey Brandon, how you doing? Hey David, how you doing? What do you think of Toronto proposing a 1% city sales tax? I mean, Toronto already has quite a sales tax. In fact, municipally speaking, they already doubled the land transfer tax. So whenever a property sells within Toronto, the land transfer tax is double what it is in Ontario, because the city already takes a fee. So they already take like a 1 or 2% fee on every transaction anyway. So it's really, just more tax. It didn't stop people from buying in Toronto before. It probably won't stop them buying in Toronto in the future. It's hard to say if it'll have a major impact. Probably have some impact for sure. The real impact is that no one can qualify at these rates. And I don't mean no one, but like very few people can qualify. And so what we're seeing on the street is that prices are falling, that the recreational markets, the second homes, the cottages, they are struggling big time right now. And it's a buying opportunity. So if you're into that game and you can weather the storm, people aren't booking as much. And like, although this is an anomaly, this place has been booked like 95% occupancy. It's like, I've been wanting to come out here, and we finally had like a 2-day book block where no one booked it. So I'm here for like 2 nights because it was the only time in the calendar it was open all of August pretty much. And so, yeah, I mean, that's bittersweet, I suppose. In this specific instance, I'm doing okay on this property, really well actually. We're getting like 10,000 a month, more than that, even 15,000. But in general, the cottage market is suffering. Airbnb is suffering. Airbnb in general is down. There are exceptions to that. Lots of properties are still flourishing. If you have a quality property, it will still do well. But yeah, I don't know. That's been on my mind for today. I'm gonna keep today's stream short because I'm dealing with this crazy rains. We got a couple floods at the properties I'm battling with right now. So I'm gonna try to keep today's stream short. I also think that we'll lose internet. We had power loss, but it's back on for a minute. The way I can tell is I have this light on over here, up in the main atrium there. It's like a 30-foot ceiling, just friggin' insane. You see that? I love this cottage. It's a beautiful, beautiful cottage. Someday I may move into this place. That would be my dream anyway, is to sell my more expensive house in London and downsize into this lodge. It's a beautiful lodge, 5-bedroom, a 5-bath, has potential to be a 5-car garage on the lake, waterfront. I own to the water, beautiful private beach, like just a beautiful, beautiful property, over an acre on the lake and Lake Huron here, and some of the most beautiful, clean, fresh water in the world, some of the best boating, the best fishing, some of the best turquoise waters on some days, and I just love it here. So that'll be my long-term play, I think, at some point, is to, well, we'll see. I don't know. We've tossed the idea around of selling our estate in London. It's almost the way that I want it. If you guys have been following my Instagram stories, you know that I've gotten the pool in there. We've got the pool house. We've got the house renovated the way we like it. We've got the guest house. We have a 1,200 square foot guest house above the 3-car garage, a detached guest house. Like, I just have a beautiful, beautiful estate, and I love it so much. And it's more than I need. The thing is, I bought the thing for, I don't know, what do we pay for it? 1.3 something. I'm probably into it for like 1.8, and it's probably worth 3.5. So I could sell it for 3.5 million and downsize into this for like 1.3 down here. And it's like probably the same thing here. Turn this from 1.3 to 2.5 or whatever over time through appreciation. I'm just going to make a point because I don't know if I've hammered it home enough, but in Canada, one of the most powerful tax policies that exist is the primary residence tax-free vehicle. It is unlimited. You could buy a house for $1 million, live in it for 25 years, and sell it for $10 million. And that entire gain is tax-free cash, which is amazing. I mean, it's just amazing that is a thing. So I'm just throwing that out there. You know what's crazy too? I was just reflecting today, meditating, laying and having a little nap and thinking about things before the stream. And I'm looking back at my goals I set for myself in 2017, 2016, 2015, 2014, even the ones I set in 2012 when I purchased my first property and did a big rehab on it in 2012, summer of 2012. So that was 11 years ago. And it's crazy to see how my goals evolved over time. And it's like, my first goal was like $1 million. And it was like, if I had like $2 million, like I'd be so set. If I had like $4 million, $5 million, I'd be so set. Then it was like, I need $10 million to have enough. And it's like, when the fuck do you have enough? Now I think it's 100 million. I actually think I need $100 million to like make sure my family is set, make sure like there is legacy wealth for everyone, make sure if like someone got cancer, we could like cure that shit, go on like some crazy like experimental treatments that might cost like $2 million. I'm worried about that shit. And it's like, why? The stress of all that's going to give me cancer. It's like, stop and smell the roses. And so part of my brain is like just observing the fact that hedonic adaptation, or the idea that the human body and mind, more importantly the mind, adjusts to any living situation. And interestingly, hedonic adaptation is such that like going down in lifestyle is a lot harder than it was going up. So if you put someone in a good environment and then take them out, they're feeling way shittier than they were before, even though they're in the exact same environment that they started in. You take them up, show them the good life, and take them away, they are in like horrible suffrage. That's why you never want to live beyond your means. People who do that tend to have, major psychological issues when things, come to an inevitable crash, because that's what happens when you live beyond your means. So it's just food for thought there, guys. Like, when is enough enough? The answer I wrote down, I was wiser then than I am now in some ways. Like in 2016 when I probably only had $1.5 million in 2016. And it's like reflecting back to, having only $1 million or whatever. And it's like my mindset then was in a lot of ways more wise than even the mindset now. And in some ways I'm for sure more advanced than I was then. And I've been growing and improving. And in my business, I'm much more astute and I can make way more dollars per hour. But it's like I wrote down 4% rule. And I forgot about that rule. It's like I haven't thought about that in a long time. The 4% rule. You need to have 25 years of living expenses set aside, inflation adjusted. You don't even need inflation adjusted because your portfolio will inflation adjust for you if you advance and put that capital into the right places. You put it in the S&P 500 as an example. You put it in real estate. All of those are inflation hedged assets. So over a 5-year period, they will grow with inflation. Your income from those assets will grow with it. So it's like, man, if you could live on like 50 grand a year, it's like 50 grand a year. Well, yeah, let's say like you had a huge family and like a lot of burn. Let's say it was like 100 grand a year. That's like, I think 100 grand, anyone can live on 100 grand a year, but let's say 100 grand a year. You only need 2.5 million to retire if you want to draw 100 grand a year at a 4% rule. Now with real estate, an 8% withdrawal rate, 4% withdrawal rate assumes you can only get 4% plus inflation. Inflation's like 3.5%, 4%. So you need to get an 8% total yield. Although I think in real estate, you can get 12 pretty easily. And inflation should be 2-3% target. So you should be able to beat inflation with real returns about 8 or 9% conservatively. So like at an 8% safe withdrawal rate, 1.25 million generates you 100 grand a year, inflation adjusted forever. So it's like, man, like a lot of us, especially in Toronto, Vancouver, people that I know, I might be talking over some of your guys' heads and I'm apologizing if I am, but there's a lot of people I know that have a house worth $1.5 million with a mortgage for $300,000-400,000. They have $1 million equity sitting in their house, doing nothing for them. They don't rent their house out at all, so it generates no income. It's just trapped, dead. And then they have $100,000 in cash sitting there, and they have a line of credit that's sitting there for 400 grand. They're not using it all. And then they have, some investments in like gold or, trapped in like equipment and stuff they're not using. It's like, man, they could reallocate the assets they have, and they have $1.5 million sitting there. They could generate them 100 grand a year. They quit their jobs. Their assets, undeployed dead capital is what I call it, like dead quiet capital. It's sitting there, money you have that's not being deployed properly. It's like, man, you could just do so much more with that. Even if it wasn't earning you income, it could be growing in appreciation in a property or something, right? Like you pull that equity out and put it to good use. Another thing I was thinking about was debt. I wrote down in my journal that I have in 2017 that rates would never exceed 5%. I didn't think interest rates would ever exceed 5%. And the reason for that was I didn't think the government could sustain payments above 5% on its debt because it would have to tax the shit out of its people, or it would have to print money to oblivion, which it can't do in this environment. And it's crazy. We actually exceeded that. I didn't think that was possible. One of my fundamental assumptions was like that we could never see inflation over 5%, and that rates as a result of that would never go over 5%. And that was wrong. We saw a spike above that. We're down below it now, but crazy, right? Crazy. Grinder says, do you see NVIDIA earnings? I did. Those guys have crushed again, and I'm short NVIDIA. So full disclosure, I am short NVIDIA. I put a short on today on NVIDIA just because I think that they're overvalued. I like what they're doing, but I think a competitor will come in and eat their lunch. I think that AI, I like NVIDIA. I don't like it at 200 times earnings, 200 years of earnings before you break even. I don't like that valuation so much. But yeah, I mean, the bull market continues. We're probably halfway through this AI bull run. And at some point it will correct. It'll be a lot like the dot-com bubble where like we thought the whole world was going to change in dot-com. Remember in 2000, we thought the world was going to like change drastically with computers, and like we overestimate how much can be done in a short period of time. But what we underestimate is how much can be done in a long period of time. So I'll say this, I love AI. I think it's going to change the face of the world, the way we do business, the way we work, and the way we do everything. But I do think that in the short term, the gains that these guys are expecting are more than they'll be able to realize. So in the short term, I think they're too optimistic. In the long term, I think they'll be able to achieve a lot of those goals. So yeah, I'll answer your question in a second, Basketball Forever. So next question, and get down the list. To get a jump in priority, you usually have to super chat. So Chuck says, I had the opportunity to buy an off-market triplex in a decent part of Toronto. The cash flow is $200 a month. Geez, 6% cap rate, which is rare in Toronto. Rents can be increased a bit too. Would you buy it? Chuck, I don't know all the details, but like that sounds pretty amazing for Toronto. 6 cap is pretty rare in Toronto. So I would say, are we sure about those numbers? Have we crunched a bit of sensitivity on the maintenance, on the capex? Are we sure that those are the actual numbers? Because people present often rosier figures than actuals, especially when they're trying to sell a building, right? And especially the realtor. You cannot rely on the realtor because they're incentivized to make the deal go through. So they don't have your best interest at heart many of the times. Something to think about. But 6 cap rate, if it is a true 6 cap rate, is quite attractive for Toronto. Pull your comps. I mean, maybe there's a reason, maybe that pocket of Toronto, that street, or something's happening there that's driven the values up. I don't know. Something is too good to be true. Sometimes it is. Often it's just not. I know a lot of people have this saying, and I hate it. It's like you get what you pay for, is the saying, or like it's too good to be true. And people who say that have really bad mindsets because you get what you can negotiate. And there are deals that are too good to be true, and they are that good. So that's my thoughts on that. There is lots. I've done tons of deals that were too good to be true, and they turned out to be that true. They just were good and great. And so, maybe could be really great. If it's on MLS, I mean, the question would be, why hasn't it sold yet? If it's that great, what are you seeing that everyone else isn't seeing? Maybe there's opportunity there. Sometimes it is. Hello, Paul. How you doing? Brandon says, do you have to pay taxes on your primary residence if you rent out half your house and then go to sell it? So Brandon, technically, it depends. My understanding is that yes, if you rent out, if like you use for commercial business purposes a part of your house and it was a substantial part of the house, like if you rented a bedroom out and it helped offset some costs and you didn't really profit from it, most accountants I don't think would even claim that as income. They would just not even mention it because your expenses were higher than your income, so there's no point in even claiming it on T776 in Canada. So I think most wouldn't even claim a small, like if you're renting out a bedroom or a small space. And if it's inconsistent, like if you did it for a few months and then you mostly just lived in the house the whole time, probably wouldn't bother. But the entire time that you live there, like 50% of your house is like rented out as a duplex, that can mess with your primary residence tax-free capital gains exemption, yes. It is why for your primary residence, you don't want a legal duplex usually. When I put them in, usually I put them in before I sell. In my case, like I have a large estate, so like the guest house is not part of my main house, and so it probably wouldn't have as much of a play. But in the early days, I did have that. I had a duplex that, I had a duplex we lived in for a year and a half, and I didn't even claim the tax-free on it. I could have claimed tax-free, but I was afraid that the CRA would see me as a flipper and see that I was like flipping primary residences, which was not the case at all. I had one kid and then I had another one and then we're gonna have a third one. And I was like, oh shoot, like we need to upsize. So we actually had that duplex and I was like, I could claim 50% of the duplex that I lived in that top unit. I could say 50% of it was tax-free, but the game was like 50 grand. So I was like, you know what? I'm just gonna claim the extra year on my next primary residence and I paid the full tax on one of the primary residences that I lived in and used that extra year for the next house that I lived in, which we lived in for like two years. So I claimed it for like, I think 3 years or something. So I just put the extra year to the next residence and paid the tax on it because I didn't want to get in trouble. And I've always erred on the side of like, whenever I file taxes, I've always erred on the side of like, if I don't have a great receipt copy that I can show, and I don't have like, it's risk of an audit, I just don't bother. I would much rather avoid an audit and pay a little extra tax than get greedy and end up having to be audited. So I just, that's how I err, is on the side of caution. And I'd rather be less greedy and not risk it. So you could risk it, I guess. Every accountant, I'm sure, would have a different opinion on this. I'm not an accountant. I'm not licensed CPA. So, talk to your CPA about this and they can figure it out with you. People are scared and comfortable. True. This is very true. And especially in these times, rightfully so, What's crazy is that like a year ago, I knew people who were borrowing money at 10% all day and were like not afraid to borrow capital. And now everyone's afraid to borrow money. When money is like, it's just crazy. Money has gotten really expensive, but like you can still borrow private money at a similar price. And it's like everyone was jumping on the private money to do flips and real estate and whatever and borrow money. And it's like now everyone's afraid. Now everyone's scared. And I've really noticed a turn in the real estate market. Like there's a lot of fear. And people who could buy before aren't. They're just sitting there scared, waiting for this bottom. The thing is, we don't know where the bottom is, right? When you're most afraid, when no one is buying, when it feels like it's going to be worse for the next year, when everyone's sure for the next year it's going to just get worse, that's when the bottom hits. So we're getting close. And it's hard to predict where that bottom is going to be. My money is still in this winter as being the bottom, but again, it's up to the Fed at this point. It's up to the economy at this point. So I do still have 18 properties currently. So it's, I don't have a small portfolio. I'm still exposed to the real estate market, but several of those are hitting the market now. I've got a couple of properties, just finished the flips on those. So we'll sell those off and probably going to take a lot less profit than I was expecting just to de-risk, because I don't want to have the risk of like having to sell them in the winter, right? And anyway, so if you're looking to buy right now, could be a good time actually. If you're looking to buy a property and hold it for 5 years, which is like most of the time, transaction costs are so high in buying and selling real estate, and the energy and mindset to buy and sell real estate, I would say don't buy and sell real estate. Buy and hold over a minimum 5-year period. And if that's the case, buying now or buying 6 months from now has very little difference. If you buy this house for $300,000 right now or $290 in like 6 months, again, you're going to sell it for $500 in 6-7 years. So do you care if you got it for $290 or $300 or $310? Like really that big difference. People are waiting and like, oh no, like I'm so afraid I'm trying to time the bottom of the market. It's like, just buy cash flow positive, quality real estate. And over 5 years, it doesn't matter. If your return's 100% or 104% or like 90% versus 105, it doesn't really matter. The direction is that right now you can negotiate really strong deals. So be throwing out offers, be really, really aggressive on your pricing, because you can. You can ask for any condition you want right now. You could ask for pretty much any price that you want right now within reason, whereas you couldn't before. And there'll be no competition coming in and take you out. So that's a special time that we're in right now. Be fearful when people are greedy, and be greedy when people are fearful. Warren Buffett. True say. That is true say. What do you think of the Canadian Fed will do September 6th meeting? I think there's probably a 70% chance that we get another hike, and then they pause for a while, because that hike would just be like a nail in the freaking coffin for real estate and for business owners here in Canada. People are struggling. They really are struggling. Half of my heart wants them to pause. I have variable rate debt as well, so like pausing would be kind of great. Part of me is like, we got to beat inflation, and the risk of inflation still running longer for higher for longer is just, man, do you guys hear that rain? Just unreal as it smacks off the roof. And we have like big timbers here to insulate us, and I can still hear it. That's how much rain we're getting right now. It's just unreal. Anyway, back to the train of thought of like, on one hand, I kind of want it because I want the bottom to hit. And I also at the same time want us to beat inflation. On the other hand, it's like, well, if we don't, then selfishly, like if they don't hike the rate this September 6th meeting, selfishly, I kind of like, that would be great for me as well. So like either way, I'm going to take advantage of it. If it goes up like 0.25%, it doesn't affect me. Like I have a couple $1 million in debt. It's minor. It doesn't really drown me, but there are people out there who are like 1 or 2 hikes from like default in their house, and they're just hanging on with their credit card and their line of credit, with everything they have. And so for those people, I'm going to pray, because it might get a little nasty this winter. I'm okay. Again, I got huge reserves, so I should be fine. But I need to stop shorting. I need to see this short through. I want to say I am thankful. I cut 40% of my short on Friday. No, well, I don't know how much it was. Maybe about a third of the short was cut on Friday. 1/3 of it was cut. And so today I'm feeling the pain of, like, from Friday to now, the NASDAQ has rallied 4%. I am short NVIDIA. I am still short the market, but less than I was on Friday. So thankful for that, I guess. But it's painful right now, guys. It's out there in the stock market. I think there's going to be pain. I mean, for some reason, the market just keeps rallying, but I think it's a bounce before one more pullback, and that would be the time where I'll go long and just DCA, which is dollar cost average, into the market and probably just stop trading. For me, it's hard to develop an alpha and an edge, and this the stress and the energy around trying to trade. It's just not worth it. Even if I could beat the market, it's not worth it for me. All right, next question. The real question is, are we actually at the bottom of the real estate market? And again, like, hard to say. You could never tell when you're at the bottom, right? But I'd put my money on this winter, and I put my money on when we have the first rate hike. Just before the first rate hike, it's going to be the bottom. when we're unsure if we're going to get that first rate hike. And when the hikes start, it should go down and then come back up as quickly as it went down. Talking about like bring rates back down to normal. So probably the time to buy is like in the next 6 months. So if you can get liquidity together, although there are people who are like, do I sell my property right now? And I'm like, if it's cash flow positive, no, hold that shit. This isn't the time to sell. There will be another bull run, and that's the time to sell. Now you want to acquire assets. You don't want to be disposing of assets. It's not a good time to dispose of assets. Of the 18 properties that I have, I'm probably going to sell a few. I'm going to hold through this bear market and see the other side through, right? It doesn't make sense to dump assets towards the bottom because we're getting towards the bottom. Where the bottom is, I don't know. Next question was, how long do you think these rates will stay high? Is this the new normal now? Are the 2 to 3% era gone? No, I don't think it is necessarily gone. I think that AI could generate a ton of additional economic productivity over the long term that will allow us to keep inflation low while they continue to print. Really, inflation is like a tax on everyone who works at everyone's assets who aren't levered. And it's just, it sucks in a lot of ways, but inflation is also amazing in a lot of ways. It allows us to keep getting wealthier and keep growing. And it does eventually lead to a currency that's worthless, unfortunately. Over a couple hundred years of 3% compounded inflation, the currency is worthless, right? So that's just a reality of things. And so I think that the lower we can keep inflation and we keep rates low and suppress things, that's good. It allows society to chug along longer before there's a reset towards a digital currency or some new, currency of some sort. So thanks, Drew. I really appreciate that comment. That's I should just block you from this channel, but that's not who I am. Not true at all. It's called investing. Thanks, Drew. Appreciate those comments. So he's saying degenerate gambler, hard to watch, destroy families' finances on a daily basis. Well, Drew, I mean, I came from nothing and I built 8 figures, right? So my net worth it's been down this year a little bit. Like I'm probably down 10 or 15% on my overall net worth, but like, again, non-consequential. Like I still have 100 years of living expenses set aside. So like my kids' are still good. But yeah, I mean, that's why when we invest, we set out our risk plan, we risk manage, we make sure that we can't blow up our whole account, right? We can't put everything, everything at risk, right? But I appreciate your comments. That's very rude of you. All right. Next question was, do you ever invest in bonds or fixed income? So my portion of fixed income in my portfolio is in private lending and mortgages. So I have about, I don't know, a quarter, a third, maybe almost 40% of my entire net worth right now is in fixed mortgages, where I get between 10 and 20% yield. And that's fixed, paid monthly. So I generate, even if I lost everything, if every dollar of my stock portfolio was gone, if all of my properties caught on fire and blew up, and like I just fucked everything up, it doesn't even matter. I still bring in like 40, 50,000 a month from the mortgage portfolio. So again, like having buckets and silos is important because if you blow one up, it's like, it doesn't matter, right? It's one of those things where like, for me, I can invest in treasury bills and bonds and make 7, 8%. But like with my network, I know of flippers and people who need capital where I can make 15% yield or at least 10%, almost risk-free. And so that's a better risk reward to me than like a 6, 7% and really it's more like 5%. Like a GIC right now is paying like at best 5%. So it's like, would I want to get a 5% or would I want to try to get, like 15 or 20, right? Okay, next question here. I sold 2 properties to de-risk away from real estate. I'm struggling with where to put the money to work. Bruno, a lot of people aren't sure right now, right? There's a challenge there, I think, with where we put our capital. I'm struggling with it too, right? It's like, you never want to have all of your capital in one bucket, right? So like, one of the things that I advocate for is like, I have Bitcoin and I have Ethereum on wallets and I have the whole crypto investment that I have a bucket where I put 5 or 10% of my net worth into that. And like, whether that plays out, maybe Bitcoin goes to 500,000. It's like, I put some there. So that's an option, right? Some people like crypto. I think that's a great space. I think Bitcoin will see $100,000 a token in the next 5 years. but it could not, right? So again, we don't want to bet the farm on one thing. It's one thesis, right? It's a speculative investment. And then I have like my rental property portfolio, where again, I think over the long term, building materials and labor will continue to rise and outpace inflation, and real estate will probably, as it's done in the last 100 years, outpace inflation again. And so I build a business around real estate where we're cash flow positive, but then we also have that appreciation piece to it as well. So you sold properties, maybe you could get back into some new properties. I've often sold my portfolio off and then bought a whole bunch more properties, like where I'll sell 9 properties and then buy 18. Because when you sell the 9 properties, you do get a huge amount of capital influx that allows you to, if you had say 30 or 40% equity in that property, you could take that and buy 2 more at 20% down. So you have net more cash flow, right? The thing I put out to people is like this: do you want 1 property fully paid off, or do you want 5 properties at 20% down? It's the same amount of money. You buy 5 $100,000 properties, $20,000 down payment on each one, or you buy 1 property, $100,000, same 100 grand. Would you rather have 1 rental property or 5? 5 is way safer. You have a tenant that destroys a property or leaves it vacant or something happens, you're 100% wiped out. If that happens here, you still have 4 more that are producing cash flow, surplus beyond the mortgage if you're buying the right kinds of real estate. Like, we're not buying single family shit that doesn't cash flow in Toronto or like LA or something. We're not stupid. Like, that's, and not say that's stupid if you have a property in Vancouver or Toronto that doesn't cash flow, because again, almost nothing cash flows. There could be a reason why. Like, maybe it's an appreciation play, maybe you're flipping it. Again, there's so many different strategies in real estate. It's hard without specific context to give any specific advice. But in general, like 90% of the properties in large metropolitan areas don't cash flow well. So what you want to do is try to buy those properties that are on the outskirts that do cash flow really well. And those ones you can hold for a long time, and it's okay. Okay, next question. I lost my train of thought here. Where are we? So feels like we're close to the bottom. Realtor in Massachusetts, no inventory and solid demand. If interest rates drop slightly, then demand is going to go up significantly, but supply will remain. So the truth is that we don't know where the bottom is. And again, another point I'll make, I've made this several times throughout different streams, is that each market is different. So you're in Massachusetts. That's totally different potentially than Ontario. One big difference between the US and in Canada is in Canada, our mortgages renew, well, first off, more than half of all Canadians are on variable rate mortgages, meaning they float just with the market prime of the bank, which is currently at 7.2% in Canada. Second thing is that most Canadians are on a 1, 2, 3, 4, or 5 year fixed. The other half of Canadians are on the 1 to 5 year fixed. So 20% of all mortgages renew every year, just by that. If assuming worst case, everyone's on a 5 year fixed, but around 20 to 30% of all mortgages renew every year. Rates went crazy last year. We've now been almost 2 years of high rates, which means that the 50% of Canadians that are variable have already felt the double in their payments for interest, right? It's now double what it was. And then another 40% or so of mortgages, the other half, are now in new locked in rates that are 5% or higher potentially. And now we're looking at, if it goes into next year, another 20% of all mortgages. Plus, when people buy and sell, they have to get a new mortgage. Sometimes they can't port it. So the answer really is like, in Canada, it's really difficult because we are so subject to current rates. Whereas in the US, you can do a 30-year fixed rate mortgage. If it was last year at 4%, you locked in at 3.8%, it's done. 30 years, 3.8%. In Canada, we have new terms every 1 to 5 years. So we're like, the Canadian market is contracted so hard because we're feeling rates so heavily. Whereas in the US, a good portion of mortgages are owned, or properties are owned outright in cash. And then another large percentage, the majority of US mortgages, are 1, assumable, where in Canada they're not. Most mortgages are not assumable in Canada, but in the US a lot of them are. And 2, commercial properties in general are more assumable than residential ones, but that's an aside, both in Canada and the US. But interesting, when you think about that how sensitive the Canadian market is and how much deeper I think the recession will be here than in the United States for that reason specifically, that the rates aren't affecting things. But commercial real estate in the United States is going to get destroyed. Like your office retail, a lot of that is on short 5-year payments, 5-year terms. So a lot of that stuff's coming up for renewals and they can't get the appraisals even, or lenders are pulling out. And so those markets are being affected deeply, I think, like your retail, your office, your malls, that kind of stuff will get way more pummeled than your single family house in the United States. So, yeah. What are the other buckets? So for me, like the main core buckets would be like, and within each bucket, there are more sub buckets. So maybe I'm being too broad. Like within equities, as an example, I have a dividend portfolio. I have like this mostly Canadian blue chip stuff. I have another portfolio that I hold that is primarily like a tech play stuff where I'm actually long tech. There's some tech names I really like. Then I have a trading portfolio that I actively check in on every day. And that one is mostly currently shorting CVNA, shorting AMC, which is those two plays have been fantastic. I'm currently short NVIDIA a little bit. It's like 1% of my portfolio. So I risked like $3,000, $4,000. It wasn't a lot. Or I think it's maybe 10 grand's the max loss on that position if NVIDIA went to $1,000 a share or something, but it doesn't matter. And then I'm short the NASDAQ. Interestingly, yesterday in that account, I was long the NASDAQ. And so I was making bank the last couple of days as it rallied. On Friday, I was like, man, we had a lot of pain really quick. We went from 387 to 355 in like 3 weeks. I was like, man, that's a huge pullback. What's normal, even in a bear market, is a bit of a bounce. So I was like, man, I'll play the bounce. So I actually rode the NASDAQ up. I was long the NASDAQ. As of today, this morning, I switched to shorting the NASDAQ again. And that's probably not played out well because NVIDIA earnings just crushed expectations. And it's like, how many more times can they crush expectations? I don't know, right? That's gambling. Again, if you don't have an edge, if there's no play there, like with AMC, there's a share dilution play. With CVNA, same thing. Like there's a lot of companies that are overvalued. And so it's more than just gambling if you can put an educated thesis behind it. But yes, totally that trading account is I have fun there. It's more like, really the only way to describe that is like my place to make bets. It is a lot like making bets, but I have higher probability of winning. And if I'm wrong, I can just collect theta decay on those contracts. Because again, I only sell call spreads and I only sell bull put spreads for the most part. So that allows me to be defined in my risk. But again, I shouldn't be doing that. Like that bucket, you guys shouldn't, none of us should be trading. There are collectively very few people on this earth that over a 25 or 30-year period with a substantial amount of capital can beat the market consistently. Very difficult to do. Very few people, net of fees. And then if you just for your time and your stress, it's like almost no one. I'll just leave that there. What else do we know? We know that within equities, you need to be very, very diversified. Owning the S&P 500 isn't enough. There's VTI as an example, which is like an ETF that follows the world indexes. You need exposure, I think, to the emerging markets. Brazil, Russia, India, China, like there's so many countries out there. You need a little exposure to all of those as well. Just being 100% Canadian equities, that's really, really narrow. You need to be way wider. So when I say like fixed income and equities, you need to be spreading it around. Ideally, also in this portfolio are businesses. If you have a business you can invest in, as an example, like I do some coaching on the side, that's a business technically. I have a social media business. YouTube is technically a business, right? It's a brand. And I can invest capital there too. And I do. I invest time and capital in my brand. And I've built a pretty strong brand and I'm proud of it. And it's like, that's something where I should be, honestly, another area, another bucket you can invest in is in yourself. Like you can invest in courses for yourself to grow your mindset. I know people who pay for coaches. Some of the business guys that I know that are just crushing like 7 and 8 figure businesses, a lot of them have weekly calls with their coach and mentor that helps them through problems. And they're like, some of them have said like, man, like that's your problem. You need that. You need a mentor in your life that's going to be like your bi-weekly or your weekly touch base that helps you keep on the straight and narrow. And maybe that's something I need actually, to be honest. Like I probably do need to find a next level coach that helps take entrepreneurs from 8 figures to 9 figures, right? And help me get on the path there. They're very, and I the worst part is that like I know that active trading doesn't beat the market, and it's hard to develop an alpha and an edge. But it's like, it really is one of those things where like there's a challenge, I think, in my mind trying to recognize like where my time is best spent. And some days I wake up and it's like my 3 kids and my wife and my family, and I care deeply and I have a large family that I care deeply for. That is like where I should be spending my time. And it doesn't have a financial ROI, but it has a really great, societal and like within my circle, a great ROI that would produce returns for me, not financially, but emotionally, right? And just like for the people around me and creating a strong social connectedness. And it just, anyway, so that's a piece of it too. And it's like, anyway, back to the buckets of what buckets you want. So I think there should be like a tech bucket. There should be like a crypto bucket. And these are small buckets. I think real estate should be a big bucket. Pretty much everyone should have exposure to real estate. And if you don't want to buy a property, you can't qualify for a property on your own, I think you should go invest in a REIT, real estate investment trust. You can get 10, 12% annual yield plus any appreciation. Over the long term, I think land, specifically real estate, with cash flowing properties on that land will outperform inflation significantly and probably outperform the S&P 500 in the next bull run. That's my opinion on that. But again, I'm biased because I'm in the real estate industry. I don't invest in any REITs, and that's because I specifically have a competitive advantage being a realtor and having previously been a wholesaler and involved in hundreds of deals. People call me and I know about things, and I have a specific expertise in the market that allows me to be better than other people. I can outperform competitors in the space. And I know for sure the REITs can't outperform me because they have to buy big buildings. It's hard for them to find deals. I can snipe little deals and get extraordinary returns, right? So that for me is like partly business, partly real estate. The next bucket is business. I kind of covered that a little bit, but like investing in yourself and that sort of thing. But like you should, if you can build out a small business, you should have a side hustle or a business that you invest in as one of your key pillars of your net worth. Every wealthy person that I know, and even if you study the greats, all of them got there through business ownership. Not through investing, through business ownership. Like even Warren Buffett, and he's like one of the best investors of all time, didn't trade his way there. I think George Soros is the only person I can think of that like, there's a few traders that have outperformed, but it's very rare. Most billionaires get there through building companies with great people and they sell that company for crazy valuation. That is how you build wealth. And in real estate, the same thing. You bring in better property management, you revamp the property, you sell that business to another person who wants like a REIT that wants a stable property. You buy a property that's unstable, bad tenants and crazy problems. You fix those problems, you stabilize the asset, you make it better. You remove yourself from that asset so it's valuable, then you sell it. You do the same thing with the business. So that should be a big bucket, I think, and it's important to have that, right? And then there's other buckets that are important too. I think like some people put bonds in this bucket, but I call this like your safe bucket. This is like and the real estate is also safe, but there are varying degrees of real estate. Like you can buy 3 cap rate buildings that are super, super like passive. You could buy 10 cap stuff that's a little bit more active, and you could buy grade A quality real estate. You can buy D quality real estate on Slum Street, So it's like, there's so much variability within that bucket. But anyway, the fixed income bucket is not tax efficient, but again, another great bucket. That's my lending business, right? I do all my lending stuff. And so for me, that's another one that's a great one as well, is just, having that additional bucket. But anyway, I'll go to the Q&A here. I'm going to lose, I think I'm going to lose power again. I just heard like a crazy gust of wind and everything that threw in there. Okay. If you can afford to buy now, I'd recommend it. Just refinance before rates drop, says basketball. Still a great time to house hack because rents are high to match these interest rates. Interesting point, actually, is that rents are actually rising almost as fast as rents have if you draw it over a longer curve. Rents are high. You can rent a 1-bedroom apartment in London for like $1,500-$1,600, which is crazy to me that like that same rent 10 years ago was like $600. So rent has tripled in a decade. That's crazy. Which does push values higher, right? If rents are high, values go high with it. Less competition in the market is a great time to buy and lock up properties. So true. Don't just buy anything though. Make sure you negotiate really, really hard. Can you give Lincoln Nguyen a shout out? I probably messed that up there, Kevin, but yeah, no problem. Happy to give a shout out. Hey, my roommate thinks he has LTV projection. How would you ask him to leave? Druggy people taking over, I feel uncomfortable, appreciate it. Man, that sucks. What's really nice is that in a shared housing situation, you as a landlord, if you share a kitchen, bathroom, common area facilities with a tenant, even if they're in a basement and they come up at all to use your kitchen, to use your living space, to use your entrance, your bathroom, whatever. This is why when I house hack, I intentionally would leave some shared common space. Intentionally. I don't want them completely separated units. Because then you can go in, and I've done this a couple times. If you share common space, they have no RTA protection at all. Residential Tenancy Act does not apply at all in Ontario, meaning they have no rights at all. The law says you have to give them reasonable notice to get out, which if they're being belligerent or in some way harmful, you can call the police to get the fuck out and they will be removed. That's it, change the locks. There's no recourse. RTA would throw it out. the LTB with the landlord tenant board would throw it out because the RTA doesn't apply. So it's important to have that, right? To make sure there's some shared accommodations in some way, right? So one of the things I would do is, like, if I'm renting out a basement, I would intentionally not put a stove in, or if I'm renting out like a space, you want them to not have a self-contained space in some way. So you have that sort of thing going. Definitely. You don't want to have tenants to have rights in Ontario. That said, like, it's not that bad for the most part. Like, and I wasn't clear whether you live there and you're the owner, but you did say you're roommates. I just assumed you're the owner, but maybe you're not. In which case, like, if you're just a tenant and they're just a tenant, you can actually file a grievance against them. They can be evicted. If you piss off other tenants enough, you can be evicted through there's a form for that. I'll try to remember the name of the form. But there is a way that the landlord can serve notice that you're disturbing the other tenants, and it will lead to eviction for that tenant doing drugs. And if there's drugs there, you can call the police too. I'm sure they wouldn't love that. There are lots of ways, right, to still work around it. And there's always just like, and this is like, I wouldn't recommend this on my channel. I don't want to say this out loud, but there are people who just strong arm the tenant out and like change the fucking locks. And it's like, see you in court. And you may get a fine. And like, if they're actually threatening your life and the law is that fucked that like you need to worry for your safety, I feel like if you present that case to the tribunal, they're probably not gonna be that hard on you. Because again, you're trying to protect your safety with drugs involved and shit like that. Like if they have weapons, I don't know the full situation, but you're saying druggy people. I just assumed that maybe they had weapons. I don't know. If they're drug dealers, maybe. Okay, so next question was, Wealthsimple has a 5% checking account for over $500,000. Good sitting in there so you know what to do with your money. Good point. Yeah, there's lots of GICs. There's 60 and 90-day GICs, which are guaranteed, which pay like 5%. Interactive Brokers is also paying like, I think, 5% or something on your cash balance just sitting there. There's lots of places you can put your money to make like a 5 to 8% yield, relatively risk-free. You could even write contracts. Oh, I just banged my knee on this tree trunk of a table. You could also write contracts on like the S&P 500, way out of the money, like spreads where your risk is defined and your loss is defined, and could make a okay return. Just doing that. Like I think some of the options contracts on the crazy days are like, and you can be 10 and 15% out of the money, which is like the chance of the NASDAQ running another 15% up, not that high, that are paying, I think like 12% yields, like 1% a month, for very little risk. Now, if you want to be greedy, don't be greedy with this money. I don't think is smart. Anytime I've ever been greedy, I've paid for it. So I'll leave that there for people to think about. Every time I'm greedy, I pay for it. Every time I take, like really good premeditated actions, I'm thankful that I did that. So, do you think it's a bad time for the lease option strategy in Alberta, specifically Calgary? Not necessarily. Like the lease option strategies can work in any market. I don't know Calgary all that well, but Calgary didn't have a boom in the same way Ontario did. So I'd be surprised if prices are as negatively affected, because typically when something has a big up, then it has a big down to kind of balance it out. So Mason, I would never just have all cash. I can't think of a good use of all cash. There is a play. I've thought about this. There is a play. I did this before several years ago where I sold everything. This is like 2017 maybe, where I sold everything, and I did it before again in 2020. I sold everything but like 6 or 7 properties. So I got almost all cash, and you can put it into like some cool whole life products. You can put it in where you can borrow all the money back. So then you now have a huge whole life policy growing with all that capital borrowed back. That could be a cool strategy. It's like an infinite banking strategy. If you're going to stay in Canada, that strategy works really well because taxes don't matter if you leave Canada, I guess. But another strategy that works really well too is taking that and putting it in like, bonds or something, and they'll let you borrow 90% loan to value in some of these bonds. So if you can find the right bond that is paying, prime +1, let's say. There were some Bell and Rogers bonds at one point in the fall that were paying that kind of rate. I was like, man, like 9% is crazy when back then prime was like 5 or 6. I was like, man, you could borrow against that 9-1 and have a little spread there. So that's an interesting like cash play, because again, Bell and Rogers are huge companies. They're not going to default on their bonds. It's very low risk. But if you had a huge collection portfolio of those bonds, that could be interesting. You borrow against that, and it'll give you 9-1 leverage, which could make your cash very powerful, potentially, very, very low risk. But yeah, lots of strategies. Just being cash is just not smart in general because inflation's so high. Hong Kong says, have you ever set rents too high on a listing? And yeah, happens all the time. You just adjust your rents down. Typically, you'll know within 2 weeks if your rent is too high because you have dozens of applicants. And if you aren't having that, there's a marketing problem or your rents are too high. Harry says, do you agree that most of the return from real estate is from appreciation? Yes. Yeah, I would say most of the return is from not appreciation precisely, but like value add. So renovation or changing a tenancy out, strategic changes to the property, that's where you add a lot of value, right? And I would say those types of strategies have made me the most amount of money. Appreciation has helped for sure. Like for sure, not having appreciation would result in a few $1,000,000 less. Like I'd probably have 60% of what I have now. If we hadn't had a big appreciation run, I would have made less, but still made money, you know? What makes it really hard to do in flipping is like what we're going through right now, where any of the flips that I bought last year, there's like a 20 to 25% pullback in prices. That is hard. When $1,000,000 properties ARV are worth $750 ARV, when $500,000 houses are worth $390, that's where like when that happens, that's hard in the business because all your profit margin, if you had bought smart, gets wiped out. Thankfully, no losses because if you bought smart, it's hard to lose money. If you're a really good practitioner, it's hard to lose money in real estate, but also possible, you know, especially if you have leverage and debt applied to these assets, possible. Cannabis REITs for 13p, interesting. Do you agree that when rates finally do drop, home prices will skyrocket? No, Chuck, I think that, you know, it'll be a slow sort of rip back. People are cautious and it takes time and the comps are old, but yes, there will be a hell of a bull run when we get rates back down to 3%. The 2 years that follow will be a good rip, I think. But it'll be slow. It won't be instant. You're not going to miss it in like a week or a month. I never knew that majority of Canadians have variable rates. Yeah, just about half. Because rates were so low, brokers tended to push variable because, again, you got to remember that in 2021, we were coming out of COVID, and we had the Fed come out and say, borrow as much as you can, stimulate the economy. We promise rates are not coming up. Literally, the Feds came out and said that. Borrow as much as you can. Invest in your home. Our prime minister came out and said, like, now's the time to, like, do renovation on your house, borrow from your line of credit. They at least said this shit to us. So, like, the narrative was rates are going to stay low forever. They've been low. They will continue to be low. We cannot have high rates. That proved to be wrong. How long will this last, though? Majority of the government's budget right now, larger than any other line item, is interest payments on debt to other nations. So we need to pay a lot more in tax if rates are going to stay this high. We already pay 55% tax at our max bracket in Canada. We're going to tax us at 65, 70%. Then we're going to pay HST, sales tax, property tax, fucking gas tax. What would be 80% of our income after all of our discretionary spending will go to tax? Like at some point, shit breaks. Rates have to fall just because how indebted Canadians are per capita and how indebted the government is per capita. Forget per capita, just raw debt is so friggin' high in the United States and in Canada that we can't keep rates high for long. It is expensive, very, very expensive to keep rates inflated this high. So, yeah. So I would bet that rates are going to fall next year. I would bet money on that fact. How much? I don't know, but they're going to fall. They'll go higher yet, but then they're going to fall. I thought buy and hold was most beneficial because of the better tax treatment. You think Airbnb is better now? So Harriet, it depends, right? Like buy and hold is better because you do get capital gains tax treatment, which means 50% of all the gain is tax-free. It is a great way to make gains. Business income is not ideal. Rental income is not ideal from a tax perspective. You're right. It's true. It's taxed worse. Airbnb can be great though. Like, it depends on the primary use. I think you can run. I still like student rentals too. I'll put this out there. Like student rentals, I've never been to the landlord-tenant board for my student rentals ever, and I had hundreds of students over the decade and a little bit more than a decade that I've been involved in the business. So, shorter term stays like that, like students that come for a year and leave or 2 years and leave, You don't have those issues, especially with good students, like quality A students whose parents sign a lease, or like engineers, doctors, whatever. They go on and move on with their life, especially in London, Ontario. They don't want to stay. They move on. And so that's great, I've found, is that type of tenant is great because you get the rent bumps. Every time rents change, you get to change with it. So that's been a business that I like. I can see myself getting back into the student rental game if I had the right partners to run operations, because I don't want to be involved. I'm over it. I don't want to be managing properties anymore. Like, I don't enjoy it. It's just not worth the money for me. But I could do it with the right employee or the right partner. Yeah, but Airbnb is good too. Airbnb is technically illegal in London. They banned it, so you can still do Airbnb, but just outside of London. You can do it on your primary residence, I think, for a certain number of days a year. But they basically banned investment properties, and that was lobbied by all of the hotels. They got together in London and pushed that agenda through. London's very corrupt city. There are so many. I probably can't share it, but I know of several instances where city inspectors were bribed and shit got done, shouldn't have got done in London, city of London, Ontario. Happens all the time. Like same within Brampton and several other cities that I know specific stories where I've seen the bribes happen, and I've heard of many others from people that I trust that the bribes get shit done. So the world's fucking corrupt. Real estate is one of those fields. It's tied in with construction in some ways. That real estate's really corrupt too. I don't know how I got on that tangent, but I shouldn't be talking about that. If I disappear tomorrow, it's like, you guys know why. Just joking. Corruption obviously exists, but it's life. Bruno says, are there other buckets? We covered that already. I think I'm through all the questions pretty much. Offices are being decimated, commercial plazas, scarce, most investors in the process of converting, 100% true, they're converting to retail, or from retail to residential. Thoughts on using HELOC to invest into the markets? Don't do it, Tony. It's very difficult to outtrade the index, but with the drag of a 7% HELOC, don't do it. That's going to make it you have to not only outperform the market, but you have to outperform it by the 7% interest you're going to have to pay on your home equity line of credit. Don't put that pressure on yourself. No, don't do it. If you're going to borrow from your HELOC, go and borrow from your HELOC and do a private mortgage. Really safe, 70% loan to value, first mortgage. That's safe. That spread is like guaranteed with very, very little risk. Guaranteed that you can pay back the money. If it doesn't, you take the property. And their 30% down payment is gone before you lose $1. That's safe. Where there's hundreds of thousands they have to lose before you lose anything. That's a safe way to do it with your HELOC. Yeah. I would borrow from a HELOC to buy a rental property because you could factor in the cost of that HELOC against the cash flow, against the net positive rental income, and you can pay the debt every month, guaranteed. You own the property, you can control that. That's a great use of a HELOC. I would use a HELOC. You borrow against a property to buy another property that produces more positive cash flow than you had before without doing that. So that works. That strategy is prudent. Not to dick ride. What kind of comment is this? Not to dick ride, but honestly, dude, how is your IQ so high? Where does your ambition, drive, and ability to manage and think through all this come from? Well, I thought it was going to be a hater comment. That was actually kind of like a positive comment. So, Denny, thank you for that. Basically, just called me smart, so appreciate that, and said I'm ambitious and drive. I don't know. There's a good study that I was reading, and a good couple of clips that I saw on Instagram that reaffirmed this recently and reminded me of it. I studied psych at Western before I went to Ivy for business, and I studied industrial organizational psych, so how you use psych to get more out of the workplace and more out of people, to manage people better. And it was interesting. People that come from trauma tend to be some of the best performers in the world. And I grew up in a ton of trauma. I was in foster care. I bounced around. I moved like 19 times as a kid. I had a really shit childhood. And so some of who I am today is because the people I was surrounded with. Like, I lived with a drug dealer for a while, and I got to learn I learned the value of money early on, right? I learned that not having money meant we starved. I learned that having money was power and control. And it was, a good quality of life versus bad. And like when pay came out on Friday, the government money that came out for when you have kids in Canada, you get free money from the government. So like that was a big piece of like why some people have kids, and it's fucked up. My child was fucked up. But when we had money, I realized that when that payment came in, life was really good. And then it was not good when that money was spent, and it wasn't managed well. So it was gone pretty quick. And I got to see, firsthand, my mom, she tried really hard, but she struggles with issues of her own, and she couldn't balance a budget either as a kid. And so it's like, I think a lot of the success that I have today stems from deprivation and hunger in my belly of like wanting to be more. And so when I found at 17 in my dorm room at Western, in my first year of university, I found financial independence, and I was like, this is it. This clicked for me. I was like, yes. And he was like, never having to worry about like your expenses. Like you have passive income coming in to cover everything no matter what. And that money's your fuck you money. No matter what the world throws at you, it's there. And that's money you can't gamble with. That's money you can't, that's like your safe money. You just don't touch that. And I have that set aside forever, and I will always have that. And it's like, now I'm just growing for the fact of growing, and it's part of it's fun. Part of it's fun to grow and to build things and to see what I can accomplish. But I think it comes from a point of deprivation. And so what you want is enough deprivation and suffering that you have hunger and motivation and drive, and probably some good genetics came in there too. I mean, I got a bit lucky in that sense. I mean, my brother has trouble functioning in society, and we grew up in a similar atmosphere. He's a very smart guy, but like full-on communist would be like an understatement, and trouble functioning a little bit, right? And it's like, why did we grow up in a similar environment and similar genetics? And it's like, why are we so different? I don't know, it's hard. I wish I had the answers to that. But in that study, what they found was the people that succeeded, that went through trauma, were the ones that were able to cope and find coping mechanisms that were not external. So they could not, like, if you went to drugs or you had to lean on some like crutch, you weren't successful. So if you go through trauma and you don't find a way through it, like I'm able to use trauma. Part of my insecurities are like lack of control. I had no control. We moved all the time. I jumped schools, and I never knew where I was going to live. I went to live with my dad for a bit, for my mom a bit, went to foster for a bit, jumped around. Like I was always, you know what I mean? Like I lived with a guy who wasn't even, I didn't live with my mom or my dad for like 6-7 years of my life. And it's like, and then I moved out on my own at 16. I didn't go home in summer. Like my house was, I don't want to get into it. But anyway, it's like that insecurity in me, in a lot of ways, like being introspective here and like oversharing, I guess, live, is my coping mechanism. Like having that passive income and that safety money and that fuck you money is like, I feel safe whenever shit's going down in my life. And it's like, today's one of those days where I'm having a hard day. And it's like, I feel comfort in knowing that I don't ever have to worry, that my family never has to worry. I don't know. For me, that's been a motivator. It's been a motivator. And again, this morning I woke up and I was like, you know what? Why am I pushing so hard? I should be enjoying more time with my family. So I love this super chat. Thank you so much, Mason. Thanks for the great streams. Always answering the questions in depth. Appreciate you. Appreciate you too. Love that. Love the super chat. That's amazing. How do I even pin this? There we go. I heard it. Okay, I think I got through all the questions here pretty much. All right, guys, appreciate everyone for tuning in tonight, and we will see you every Wednesday like we do every week. We'll see you next Wednesday, 7 to 8 p.m. Eastern Standard Time, give or take 10 or 15 minutes. Looks like the rain's kind of held up a little bit. Look at that beautiful lake. I've got 270-degree views of that lake. Just amazing. Just beautiful. All right, I'll leave you guys with that. And I'll leave you with my catchphrase that I use every week, which is the secret to unlocking your wealth through you is as simple as 3 levers and control your financial future. Spend less, earn more, and maximize returns to the difference. That's it. That's the secret to building wealth. That's the secret to prosperity in life. That's it. That's all you got to do is just follow those 3 levers and you will build the life that you want. And early retirement's really 5 or 10 years maximum away from your life. So you can have it. You can have it all. See you next week, guys.